Secretary Yellen, thank you so much for joining us this morning. It's a pleasure to have you here.
My pleasure. Thanks so much for the invitation.
Let's start with the inflation report that just came out. Inflation has been much better behaved in the second half of the year. Headline inflation is down to 3.1% in November from 9.1% in June of last year. Core prices rose last month 0.3% from October. That's a 3.5% annualized rate. Is inflation vanquished?
It's certainly meaningfully coming down, and I see no reason on the path that we're currently on why inflation shouldn't gradually decline to levels that are consistent with the Fed's mandate and targets. So supply chain issues that resulted from the pandemic and mismatches and disruption in labor markets both seem to be healing. As that happens, inflation's moved down. The labor market, while it remains very strong, obviously we've had 22 months now with below 4% inflation, which is quite a phenomenon. I think we haven't seen that in about 50 years. Still, the labor market is cooling some. As job openings come down, the intensity of hiring is diminished some, but of course we haven't seen layoffs, and we have excellent job creation, labor force participation increasing. And at this point, with inflation down so much and wage increases continuing at a healthy pace, real wages are rising. I believe we saw this morning that real average hourly earnings are up 1.4% over the last year.
So there's a view among the economics commentariat that I often hear that says the last mile of getting inflation down will be the hardest. What do you think? Could inflation be more persistent if the unemployment rate continues to run below 4% and wage growth runs above 4%?
Well, we're seeing wage growth, nominal wage growth, gradually diminish. And as price pressures decline, real wages are rising, but productivity has been pretty healthy, and we're not seeing pressure on unit labor costs. I personally don't see any good reason to think that the last mile is going to be especially difficult. I think we have an economy that's roughly operating at full employment, and it can continue to do so. I think people predicted that unemployment was going to have to rise considerably in order to get inflation down. But inflation expectations are an important element in the inflation process. And inflation expectations, well, recent data suggests they've come down, but I think that they've been well under control. And that's important because it means that there is no underlying inflation momentum that we would need a softer labor market to manage to bring down.
So on that point, over the last couple of years, the two big worries that you hear about from economists are we're going to have a wage price spiral or inflation expectations are going to become unanchored. Do you think policymakers have cut off those tails? Are those no longer things we need to be so worried about?
Policymakers are paid to worry, so we always worry about some things, but that's low on my worry list. I don't see any evidence that inflation has become ingrained or that we have a wage price spiral. Neither of those things seem to me to be problems that we're dealing with. And, the Fed has done a good job of managing policy. As I said, importantly, the labor market is showing signs of less stress. So while wage growth is healthy, it's come down some, and real wages are again rising.
Well, and on the point about expectations being anchored, I mean, markets certainly seem to agree. Bond markets think interest rates are going to be lower next year. Is it plausible to have interest rates coming down when inflation is still above 2%?
So the decision of what the right monetary policy is up to the Fed. I'm
I
not
thought you
going.
would say that.
I'm not going to comment on what they should do. I think they need to carefully watch the economy and make a judgment about what's appropriate. Of course, as inflation comes down, other things equal, real interest rates tend to rise, which causes a tightening of monetary policy in a sense. So that's one factor that could weigh in a decision that the Fed makes about the path of interest rates.
So I want to take a step back and take stock of what we've learned about inflation over the last 2 years. I know people will be writing their PhDs about this years from now, but I'm curious to get your preliminary assessment. What caused inflation to go up so much, and why has it fallen seemingly without any serious weakness in the economy so far?
So I do think we don't know the answer to this at this point, and it's appropriate that there be some PhD theses and a lot of research papers on this, and there's going to be time in the years ahead. But just looking at what's happened, I think there were very significant supply disturbances that were caused by the pandemic, shortages, big shifts in the structure of demand that led to sectors like automobiles that were faced with enormous excess demand, shortages of chips, shipping, huge increase in shipping costs from Asia. So these supply disruptions have gradually come down, and I can't say exactly how much that's contributed to lower inflation. I think that's been a factor. You also had enormous disruption in the labor market with a very significant number of people laid off or losing their jobs who need to find new work. And I think that led to disruptions in the labor market that are also gradually healing. In a way, the natural rate of unemployment, I believe, is coming down as people settle into new jobs. I mean, that's a very disruptive process. We saw not only desperation on the part of firms as the economy picked up and they were desperately trying to add to their workforce, but mismatch of workers and firms that led people to quit their jobs, look for other works until they settled into a good match. So quits were unusually high, job openings were very high, wage increases were very high as the labor market had been so disrupted. But now if you look at it, job openings are down substantially. I don't mean by that to levels that are worrisome low, but to normal good labor market, pre-pandemic levels. The quit rate, which is, I think, a driver of wage increases. Firms tend to bid up wages substantially.
Workers quit their jobs when they think they can get a better price somewhere else.
Absolutely, and you're seeing quit rates come down, again, toward normal levels. So the labor market's normalizing, and labor force participation has moved up, certainly among adults. We've seen it move up to the highest levels in decades, and that's helping to ease inflationary pressures as well.
So you've said you see a soft landing as the most likely outcome for the economy. Do I have that right?
Yes, in the sense that, to me, a soft landing is the economy continues to grow, the labor market remains strong, and inflation comes down. And I believe that's the path we're on.
Because when I look back over history, soft landings are quite rare. In 2000 and 2007, there was a lot of optimism that the economy was slowing into a soft landing. Most recessions look like soft landings for a little while. What gives you confidence that this might be more like the episode in the mid-1990s than in the last two downturns, absent the COVID shock, where it looked like we were soft landing and then we had a hard landing?
Well, I agree with you that it is an unusual thing to have happen. And it certainly takes skill on the part of the Fed to calibrate monetary policy properly. But if you just look at the data, it looks as though that's the path we're on. And I will say that for the last several years, what I've been saying when asked about the economy is that I believe it's possible to have a soft landing, that there's nothing inherent about the shocks that have hit the economy that make it necessary to have a period of high unemployment to get inflation down. So many economists were saying there's no way for inflation to get back to normal without its entailing a period of high unemployment, a recession. And a year ago, I think many economists were saying a recession was inevitable. But actually, I've never felt there was a solid intellectual basis for making such a prediction, because as long as inflation, I mean, the times when you've, in the United States, in a sense, needed a downturn to get inflation down, those were periods like after the oil shocks of the 70s, when inflation expectations were clearly had moved much higher. And inflation then becomes self-perpetuating. You have a wage price spiral that really the only way to bring inflation down is getting inflation expectations down, and that involves a period of high unemployment that pushes inflation down and shows people you were wrong, inflation's actually lower than you thought. That's a painful process. We didn't need that. And because inflation expectations had never meaningfully ratcheted up on a long-term basis, we just had to have the economy normalize and get the labor market back to a sort of full employment state to bring inflation down. Now, of course, there were shocks along the way. Russia's invasion of Ukraine led to soaring food and energy prices that of course boosted inflation and had the potential to dislodge inflation expectations. So there have been many risks along the way, but we've managed to avoid the adverse real consequences of those risks. And I think we're on a soft landing path, which is highly desirable, of course.
So I don't have to tell you this, but there's a disconnect right now. You see some of the surveys, people say they're very unhappy with the economy. They feel worse off than 3 years ago. But you look at these kind of headline numbers and you say, well, what's not to like about low unemployment and inflation coming down? Why do you think there is this disconnect? And are you concerned about the fact that the administration's message around Bidenomics isn't landing?
So I think we've been through a lot. The pandemic caused an enormous amount of disruption in people's lives. And we're still in the aftermath of what's been a serious shock. And we've had serious global shocks. And although prices are rising at a much slower pace than they were, inflation is substantially off its highs. The level of prices of some things that people buy and are important to them are higher. A good example would be rents. Rents have gone up considerably. And the cost of, if you're in the market to buy a new home at this point, with mortgage rates and house prices having increased. And I think a lot of young people who are in the market, want to start families, are renting, want to buy a house. And we see shelter costs continue to rise. Now, the prices of new rentals have stabilized, and that means that over time, shelter inflation will come down, bringing headline inflation and core down as well. But people are seeing increases in rental costs, and that's an important aspect of their cost of living. But the Biden administration is doing all that it can and taking steps I think are very meaningful to lower costs in areas where they can. An example would be capping insulin prices for seniors at $35. We now have prescription drug prices coming down. The whole energy, the Inflation Reduction Act, the energy initiatives in that, and the bipartisan infrastructure law will bring energy prices down over time. And so the Biden administration certainly understands that high prices, even if they're no longer rising, are definitely a concern to Americans, and we're trying to take the steps we can to address these prices.
You mentioned mortgage rates. It's been an interesting period in the U.S. Treasury market. We saw a big sell-off in October, rates on the 10-year note up to 5%. Now they're back to maybe 4.25%. How much of the stability in bond markets since November do you attribute to the Treasury's decision to issue fewer long-term securities than the market expected? And was that a deviation from the Treasury's protocol of regular and predictable issuance?
So regular and predictable issuance is the core strategy the Treasury follows. Experience shows that regular and predictable issuance is central to keeping borrowing costs contained over time. We routinely confer with market participants to understand changes in the market, shifts in demands for different maturities of securities, and our borrowing needs, of course, shift. And really, the adjustment that was made, I guess it was in November, was really quite marginal. We've been increasing our issuance in order to finance deficits, and we made a marginal adjustment to increase issuance a bit less at the long end, given the strains we saw there. But really regular and predictable. We do not, as a routine matter, respond to movements in market rates.
Well, so if tax receipts were to come in below forecasts and you're forced to issue more, would you keep issuance lighter on the long end of the curve in the future, given concerns about demand for duration?
I'm not sure. I don't, no decision about that's been made. But we do get the advice of market participants and are trying to understand what's best.
More broadly, is the long-term fiscal picture for the U.S. sustainable, particularly if the average interest rate on the public debt is higher in the coming years and we don't go back to the very low interest rates that prevailed before the pandemic?
Well, one way I judge sustainability of our fiscal path is by looking at the net real interest costs on the debt, which is our financing costs in real or inflation-adjusted terms. And that has been quite moderate and well within historical norms, projected as over time to rise somewhat, but still in our sort of last budget toward levels that are not worrisome. But if higher interest rates, if interest rates are substantially higher on a long-term basis than we previously projected, of course that results in some extra stress on the fiscal outlook. The president has recognized that it's necessary to take steps to reduce the deficit over time, to have a more fiscally sustainable policy. And he's proposed in his last budget $2.5 trillion of deficit reduction. A lot of this comes about through tax rates that are higher on corporations and wealthy individuals. Our tax collections, as a consequence of the Job Cuts and Tax Act in 2017, have fallen to historically low levels. Taxes as share of GDP are now at 16.5%. So that's about 1.5% of GDP below projections before the act was passed. And the president has proposed a large number of ways to make up that gap. In addition, we have in the United States an utterly enormous tax gap, and there I'm referring to the difference between the taxes that are actually collected and the taxes that are due under our existing tax code. And that ranges, the estimate over a decade is $7 trillion. Congress allocated $80 billion in the Inflation Reduction Act to restore the capacity of the Internal Revenue Service to hire the kinds of personnel, tax lawyers, accountants, who are able to enforce the tax code. And that is going to have a substantial payoff over time. The Republicans recently proposed, and we did agree to take $20 billion of that back. That's no economy at all. That's a totally false economy, because taking money away from the Internal Revenue Service, and CBO has shown this in their estimates, it doesn't reduce the deficit, it raises the deficit, because this money goes to close that tax gap. It makes a considerable difference. So we have opportunities on the revenue side. I think that needs to be part of any plan. And of course, with an aging society, we do have greater spending we have to foresee on Medicare and Social Security that may need to be addressed.
Before we close, I want to ask you, you were in the APEC meetings in San Francisco last month in the meeting with the Chinese leader Xi Jinping. What should be the goal of U.S. engagement with China, given so much of the frustration and maybe disappointment over the last 20 years? Is the U.S. doing enough to de-risk from China, in your view, and is there a danger of doing too much de-risking?
So I see a three-part agenda with respect to China. The first is that we want to have a relationship that involves healthy competition, trade, investment that is broadly beneficial both to the United States and to China, is good for businesses. China is a huge market and is good for American workers, creates jobs. So we do not want to decouple. The Biden administration does not seek to decouple from China, but we do seek to de-risk. And that means we don't want to be overly dependent when it comes to key supply chains on China. Instead, I've promoted an approach called friendshoring, which involves diversifying our supply chains. And we're working with India, Vietnam, with Mexico, with Indonesia, with other countries to continue to get the benefits of international trade, but to be less reliant on China. We also need a level playing field, and the president in his meeting with Xi, and I met a few days before that with my Chinese counterpart. China has practices that result in unfair trade, subsidies, intellectual property practices that create an unlevel playing field that we intend to address, but no decoupling and continued engagement. That's plank one. Plank two, we're going to protect our national security and speak out about human rights. And there's no compromising about that, but we'll try to make our approach as narrow, as targeted as we possibly can. And I'd say the recent rules that we put forward with respect to outbound investment, where we do see some dangers of U.S. firms investing in China, are very narrowly targeted at advanced semiconductors, artificial intelligence, quantum computing, and with real national security implications. And the third plank of the China policy is we need to cooperate to address global challenges. We have a responsibility to the world to do that. Two areas that are very important are climate change and debt, that there are a lot of countries around the world are really suffering, especially with high interest rates, from unsustainable debt burdens. They need to restructure their debt, and we need to cooperate to do it. And China is one of the biggest lenders. So we need to work. This isn't a US-China issue, it's a multilateral issue, but we are in regular conversations with our Chinese counterparts to try to make progress in these areas, and I feel encouraged by the signs that things are getting better.
Thank you for that. We're nearly out of time. Maybe a quick lightning round here. You're one of just two people who have been chair of the Fed and Treasury Secretary. What are the biggest differences between those two jobs?
The Fed's job is very focused, mainly on, well, supervision, of course, is an important piece of the Fed's job. But with respect to the economy, it's focusing on constructing a monetary policy that best allows attainment of price stability, maximum employment mandate. The Treasury's jobs are very, very broad. I've never been in a position where the responsibilities are so diverse. We have 1,000 people who work at Treasury who deal with sanctions and threats from terrorist financing, illicit finance. We have tax policy, international economic relations with a variety of countries, represent the United States in the multilateral development banks and the IMF, and on and on. So the range of responsibilities at Treasury is really enormous.
Which job is better?
They're both great. I'm a lucky person to have had either of them.